the Business Breakdown Bureau, where profits get exposed and strategies get dissected.
Uber has lost over $30 billion since it was founded. Yet somehow, it's still one of the most valuable companies in the world. How does a business bleed billions for years and still grow? The answer lies in a strategy that rewrote the rules of the modern economy and changed how we think about success. Let's start with the basics. Uber is what's called a platform business. It doesn't own the cars, and the drivers aren't employees. It simply connects supply and demand, riders and drivers, through an app. But unlike traditional businesses, Uber never focused on making profit early on. Its goal? Market domination, at any cost. To achieve that, Uber did two things. First, it subsidized rides to attract customers. Cheaper than a taxi, more convenient than the bus. Second, it incentivized drivers with bonuses and guarantees, paying them more than what riders were charged. So Uber was losing money on every ride. But it didn't matter, because this strategy was about scale, not sustainability. By flooding markets with cheap rides and overpaying drivers, Uber crushed local taxi competitors. It became the default option in major cities, not through profit, but through aggressive, subsidized growth. And this was funded by something most startups only dream of: billions in venture capital. Investors poured money into Uber because they saw the big picture. Owning the transportation layer of modern cities. Capturing market share now, and squeezing profit later. But that's not the full story. Uber also expanded beyond ride-sharing. Uber Eats, Uber Freight, autonomous vehicle research. Each one designed to increase reach, reduce costs, or build a future mode. Yet, with all this expansion, the losses kept mounting. In 2019 alone, Uber lost over $8.5 billion. And even after going public, it continued to burn cash. So how did the stock survive? Because the growth narrative remained strong. As long as Uber could show rising users, increasing trips, and expanding services, investors believed. And here's where it gets interesting. In 2023, Uber reported its first full-year operating profit. Not because it suddenly reinvented its business, but because it gradually started pulling back on subsidies, raising prices, and leveraging the scale it had already built. It took a decade of unprofitability to finally reach a point where its network effect could start paying off. This is the modern Silicon Valley playbook. Growth first, profit later. Dominate the market while losses are acceptable, then slowly squeeze efficiency. Uber's not alone. Companies like Spotify, DoorDash, and even Amazon did this in their early years. But Uber's scale and losses made it the poster child of this strategy. So yes, Uber lost billions. But it gained something even more valuable: market share, user behavior, and global mindshare. In the long run, that might be worth more than any short-term profit. The real question is, will Uber become the next Amazon, or the next WeWork? Only time will tell.